Great. Good morning, good afternoon, good evening if you are in Asia, depending on wherever you are. Welcome to another fabulous episode of our webinars in partnership with S&P Global Platts. You've heard us before once we tackled and discussed the oil crash that was literally the day after the prices went into negative on the futures contracts in the U.S. And today, another one of our fabulous episodes, continuation into this webinar series. And today we will be tackling the changing landscape of natural gas in Europe. Obviously, we will discuss the coal to gas switching, current support for gas prices, and the future in the European energy transition. I'm delighted to have some of our esteemed analysts from both sides, from Refinitiv as well as S&P Global Platts, who have joined us today. And we are looking forward to another one of these interactive sessions where you will be able to ask a number of questions. We will hear the insights from Wayne and Anna Maria, and definitely you will receive a recording of the webinar at the end of it as well. So before I go into properly introducing the speakers, obviously I think many of you might be aware that the key discussion points for us today will be the share of gas in the total flexible thermal generation capacity across the continent and Northwest Europe, the drivers behind the European gas price bearishness and the short-term outlook, as well as the context of the energy transition and how it is impacting the gas switching. Many of you might have seen this news item from BBC this morning that UK has been free of coal for a while now and quite a move away from the fossil fuels in power generation. It's a very timely and exciting webinar, in my view, that we will hear from Refinitiv and our S&P Global partners and the experts as well. Let me quickly introduce you to our speakers. Wayne Bryant, well-known figure in media and many of the outlets. You must have seen him around. He's the Director of European Gas Research for Refinitiv. Wayne studied finance, both at bachelor's and master's level, and after which he worked as a graduate analyst at a major energy supplier before moving into the consultant's role. And then obviously he moved into a trader and analyst role that he's been well known for. Wayne is a frequent commentator, very well quoted in media. He speaks a lot about the global energy matters. And obviously, in addition to that, you hear him hosting a number of industry webinars, energy conferences, and a podcast series that hopefully will be coming out very soon as well. Wayne is an expert on the European gas and related markets and also a competitive runner and been running a number of London marathons. Hopefully this year as well, when we can see you running again in a quick time as well. And also we're delighted to have Anna Maria join us today. She is the Senior Power Analyst at S&P Global Platts Analytics. Anna Maria is part of the European Gas and Power Analytics team of S&P Global Platts in London, where she analyzes the models, power price and fundamentals, as well as managing the team's goal to gas switching model. Anna Maria is also the lead analyst in modeling for the longer-term power within the energy transition context and shapes up the team's content within the wider ESG discussions and arena as well. Anna Maria has over 7 years' worth of experience in the energy markets, including energy efficiency, European energy policy and commodities, and also she's been producing a great degree of thought leadership for a UK-based LNG and gas consultancy as well. A few very brief housekeeping announcements. As usual, you are well aware of the mechanism that we employ in this webinar. We would love to have your questions come in, feedback, thoughts, comments, and there's a little Q&A tab or a box that you will see in a bar at the bottom of your screen, just underneath where the slides are appearing in. So please do feel free to post in any questions that you might have. And if we will try and answer them at the very end. And if you run out of time, then obviously what we will do is to reach out to you individually with any one of your questions, and we can answer them there and then as well. Also, I should remind you, there are a number of resources available, some PDFs, some links that are available to you, again, via that bar, that you would be able to download some PDFs, and you would be able to read through a number of recent enhancements and content and research available via Icon, as well as some of the new launches that we've had from S&P Global Platts, now available via Icon, that you can request them via that as well. So with that, a bit of context and background, Wayne and Anna Maria, over to you guys to get started with the webinar.
Thank you so much, Rohan. Hi, everyone. My name is Anna Maria Tolbaru. I am a power analyst with Platts Analytics in the London Gas and Power team. And I want to talk to you today about the relationship between Northwest European power markets and gas. This is a very interdependent relationship. And for the continental Northwest Europe, it has become so over the past year. We see this relationship stay strong in the short term and even intensify in the longer term. For this presentation, I will focus on continental Northwest Europe, meaning Belgium, France, the Netherlands, and Germany. First, I'll take you through the changes we are seeing in gas generation. You will notice how the power market is having to increasingly rely on gas to take the swing from wind or demand. And this is because gas dominates the thermal gap. This means also that continental European gas is itself increasingly dependent on whatever happens in power markets. Nuclear and wind output or demand changes, they're forces that exert either upwards or downwards pressure on the switching channel and impact the levels of CCGT dispatch we see materialize. This rather new level of interdependency between power and gas markets in continental Northwest Europe, we believe, is actually here to stay, with nuclear and coal starting to decommission as renewables increase. In other words, with the energy transition underway, the power market's reliance on gas will only intensify, at least in the medium term. But let's start with the recent gas running patterns. Remember, until last year in Germany, which has the largest fleets, it was coal and lignite that were dominated the flexible thermal mix. And this limited the region's demand for gas in the power sector. In 2020 to date, across Germany, France, Netherlands, and Belgium, gas has been running on average almost as hard as last year, an average of around 16.4 gigawatts. Indeed, you'll probably notice here in the chart the drop in April due to the lockdown measures, but really, this chart itself is far from striking. What is more striking, perhaps, is this. There were two forces narrowing the space in the market for flexible fuels, yet gas generation averaged similar to last year. First, we have had a very windy year. Wind generation across Northwest Europe hit a new record high in February, a monthly average of 39 gigawatts, with January also a record for the month. March, April, and May not far behind. Meanwhile, demand dropped steeply across these markets because of the coronavirus-related lockdowns. It fell versus its 5-year average by a combined 15 gigawatts in week 13, or mid-March, and by almost 20 gigawatts at the start of April. Coal generation, meanwhile, has dropped to fresh lows. Last year, we noticed a floor to German gas run of about 4 gigawatts on a monthly average basis, and we assumed this to be non-price responsive. However, this year coal has dropped to about 2 gigawatts on a monthly average. In France, meanwhile, there is hardly any coal running at all, hasn't been since last summer, lifting only when the market tightens in winters. And in the Netherlands, too, coal levels halved year-on-year in Q1 and April. You will see from the right chart that there is a similar situation with lignite generation. We assumed must-run lignite to average on a monthly basis at around 8 gigawatts before, but this year that average dropped to just below 6. You can see just how unusual this is by looking at how steady and elevated lignite generation was in 2018 and 2017. We expect this trend to continue. You can see, if you follow the black line in the central chart, that we are forecasting strong gas running for the balance of this year and beyond it too. In Germany, we even expected to overtake UK gas burn. Just to give you some numbers, we are expecting about 10 gigawatts more gas running year-on-year this Q4, and this is only in continental Northwest Europe alone. This translates into an extra 43 MCM per day if we use a 49% efficient gas plant, for instance. So the Q4 total for Northwest Europe would amount to gas dispatch of around 140 MCM per day. Now, the two charts below show our forecast of coal and lignite generation versus historical outturn. And with the black lines mostly below the colored ones, you can see how coal and lignite have had a hard time recovering to pre-2019 levels, especially in summers. Yet the gas outturn levels I started the presentation with, as well as perhaps seeing the different fuels in separate charts, these don't quite paint the wider picture. So let's take a step back and look right from the start of winter 16, for instance. This really puts things into perspective. This chart shows the percentage of gas generation out of combined coal and gas running in Northwest Europe, and also the monthly average coal and gas values. You can see how the share of gas is increasing versus coal towards the end of 2018. And then it continues to increase in 2019, 2020. What we are seeing here, put from a historical point of view, is a new trend emerging on the continent, really a stabilization of gas over coal running. The other line in the chart on the y-axis shows the differential between TTF and the coal switching price. At a differential of what we are seeing here of around €9 below this benchmark CSP, we are already quite deep within the switching channel, so a lot of switching has already occurred. In fact, at this differential, we see full switch with all switchable coal, and we have already entered the lignite tranche of the channel. And indeed, if we look at this chart, this is what has been happening, and it is in line with what we have been forecasting. You see here a similar chart to the one before. From this, it is clear that gas has been taking market share from lignite too. And notice just how unusual this sits with historical behavior. In fact, what I'm showing here is the flexible thermal gap of continental Northwest Europe, or coal, lignite, and gas generation combined. And I showed you that gas has been taking the lion's share of the thermal gap. However, this gap, and within it the distribution of the different fuels, depends very much on whatever else is happening in the power market. So why hasn't gas generation outturned higher? Here is the thermal gap in another form. This looks at a 5-year horizon, and there is a lot going on in this chart, but what I want you to take away from it is the following. Especially nuclear, but also wind, form a significant portion of that chunk of generation you see there below before we get to the total thermal channel. Beyond pre-existing switching from our model in Aurora, we have further possible interaction between gas, lignite, and coal in that switchable area. But both the must-run gas part and the switchable coal and lignite chunk are a function of whatever else happens, in particular with nuclear, renewables, net flows, and demand. So gas running is very dependent on whatever else is happening in power. And having a good power forecast, a switching channel forecast, and within it a dispatch logic for gas are all key to a successful gas view. And at Platts Analytics, we have a roster of expertise across commodities like gas, LNG, power, carbon, and so on. And it's great because you clearly see here how dependent they are on each other and how much working across commodities can enhance the quality of a forecast or a risk analysis. Now, let's see how the switching channel is either wider or narrower with power market changes. And I am not short of examples here. We have had quite a few exciting months. Some of the key developments in Northwest Europe have been the power demand destruction due to coronavirus, but also EDF's nuclear production cut. To start with demand, this chart shows the absolute deviation in power demand for each of these European markets from their 5-year average. You can see here that the steepest drop started somewhere around week 12, so around mid-March, and it has been very intense until week 17, so the end of April. Since then, the loss versus the 5-year has been more stable. But what I want you to focus here is on the sharper drop mid-March, because that was also when we first implemented some demand assumption changes in our model. At that point, we had limited information, and we assumed containment measures would result in a drop in demand of around 10% versus base case in Q2. And actually checking against outturn, we have called it right for most markets. Now, implementing these demand changes had a significant impact on our summer 20 switching channel. The top of our channel dropped by around 50%, and the bottom also dropped by about 60%. But what does this mean? Well, one way to start is first by explaining the min and max, these two limits of the channel. So first, let's look at the volume channel. What defines the borders of a coal and lignite to gas switching channel? First, we start with a level of minimum gas run. This is the amount of gas running you'd see if, for instance, all of your available coal and lignite land were running, and there would still be a portion of the thermal gap left and needed to meet power demand. This is a dynamic min level that changes with our forecast of total thermal generation. Meanwhile, historical observations have also showed a minimum gas running level on a monthly average basis that seems to be non-price responsive to us. So we don't let our dynamic min levels drop below those historical minimums. Then we have the max of a channel, and that is the amount of gas running you'd see if full switching from coal and lignite occurred, and that is limited by gas plant availability. But if we open this up further and have a look at that maximum potential of the channel, we start with our forecast of gas generation, which encapsulates some pre-existing switching. To that, we add what we call remaining switchable capacity. And the way we calculate this is we take total coal and lignite generation from our model in Aurora, from which we deduct our estimate of unswitchable or must-run coal and gas. And this remaining switchable volume provides the upside and therefore the maximum to gas generation in our forecast. So all other things being equal, using a lower gas price, we'd probably have less of the remaining switchable volume and more gas in that tranche. Now, I explained the min and the max, so let's see what impact those demand assumption changes have had in our continental Northwest European switching channel. Lower demand resulted to a large extent in a steep drop in our gas, coal, and lignite generation for Q2 and Q3. In other words, it squeezed the thermal gap. And the result, as you can see in the chart, is that the min levels fell effectively to gas must run to an average of just under 20 MCM per day. And then the top of the channel fell by 52%, or by an average 49 MCM per day. Clearly, this reduced support for gas prices this summer. Then on the 16th of April, an announcement by EDF brought a new shock to electricity markets in Europe. But this sort of development has been bullish instead for gas prices. Each year, EDF announces a target of nuclear generation, and this provides guidance to a lot of forecasts. What happened on the 16th, as many of you must know, is that EDF lowered that nuclear production target for 2020 with an impact up until 2022. And you can see from this chart, we have two red lines, and the first dotted one is our view of French nuclear generation before the EDF announcements, and then the solid red line is our view afterwards. Quite a hefty drop. The result was that some months saw French nuclear output reduced by 14 gigawatts or more versus our previous view. But beyond the impact on French gas generation, the drop in nuclear also meant lower French power exports. In turn, this has lifted gas generation in neighboring markets. In our forecast, we cover 10 Western European power markets, and for some months, due to the lower French power exports, gas running lifted across them by an average 16 gigawatts. But what about the full potential of gas running volume within the volume channel, within the switching channel? How was that impacted by this change in nuclear? In fact, you will see from the chart on the screen, comparing our view before those changes to our view after those changes, the switching channel saw the max increase by 60 MCM per day for Q3 to 136 MCM per day. And if you were wondering, that is an 80% increase. You can see from this chart that the EDF revision should compensate the impact on gas demand from the large demand destruction. And notice just what a huge swing factor French nuclear is to the switching channel. Now, our gas dispatch view and price view really sits with the gas team rather than the power team, but I know that for the rest of the summer, we see gas being dispatched in about 90% of the channel. With a Q3 TTF contract trading close to €5 per megawatt hour, the market is looking for price anchors and any support that could prevent further declines. But there is clear risk to that view of French nuclear, and the risk for gas demand, we believe, is weighted to the downside. We believe that the 2020 EDF target is extremely cautious. If we take the 300 terawatt-hour target as a rigid constraint, output has to average 29 gigawatts at the end of the year to achieve it. And this translates to 24, 25 gigawatts between July and September to allow a sufficient recovery in Q4. And this is our base case. But in a scenario, we try to test the upside risk to nuclear production for Q3. So we lifted Q3 nuclear output to an average 28 gigawatts. So that is about 4 gigawatts higher than our base case for the quarter. And if we look at the impact, you can see in the left chart that this translates not only in higher gas running in France, but also more net French exports. In terms of our switching channel, the change sees the top of the channel drop by about 6 MCM per day in August. But more interesting perhaps is the impact of lower French power exports on gas running in neighboring markets. Of higher French power exports on neighboring markets. You can see how Spain is very impacted with gas generation there down by about 1.5 gigawatts in September as a result. So yes, the gas market and the switching channel itself are very dependent on power market fundamentals. And of course, we expect this to continue. But what's more, we expect power markets themselves to become increasingly dependent on gas to balance amid the energy transition. First, let's look at our switching channel with a longer-term horizon. So I'll start with a max. As I said, this is the sum of our gas generation forecast and our view of switchable coal and lignite. And one key thing you notice here is that the top is fairly stable and that some switching channels in Northwest Europe disappear. For instance, French coal closes by 2022 and that switching channel disappears. Then between now and the end of 2025, Germany closes down just over 6 gigawatts of coal capacity. It also loses about 3.5 gigawatts of lignite. And this amounts to about 10 gigawatts of combined coal and lignite losses in Germany. Still, the installed capacity that remains is large, about 18 gigawatts installed coal and 14 gigawatts lignite by 2025. And we expect this to run harder as of 2023 as the thermal gap in Germany widens up on nuclear closures. More exactly, we are forecasting 14 gigawatts of closures across continental Northwest Europe alone. Note in the left chart how Germany shuts down nuclear entirely by 2023 and Belgium by 2025. The only countries left with nuclear by 2025 in Northwest Europe will be France and Netherlands. Another thing to note when you look at this chart, in fact, is French nuclear. You can see how it will remain a key swing factor for changes in the switching channel for years to come. But another key thing to note is, of course, the rise in renewables. Across these four markets, we expect wind capacity to increase by a combined 38 gigawatts and solar by almost 42 gigawatts. This gives a total of 80 gigawatts of wind and solar additions in this region alone within our 5-year horizon. So what is the impact of these on the rest of the switching channel? Let's check our actual gas and wind generation forecast first. And there are two main things I wanted you to take away from these charts. Wind generation across the four markets in Northwest Europe lifts by an average of almost 9 gigawatts in 2025 versus 2019 outturn. However, gas generation across these markets in 2025 is almost on average the same as in 2019. What the lines show, however, is how the annual shape of gas generation is impacted. You can see winter 25 surpasses winter 19. That is by an average of 2 gigawatts, for Q4 alone by more than 3 gigawatts. Notice how in summer 25 versus summer 19, gas generation is lower by about as much as 5 gigawatts, pushed down by wind and solar additions, but also by growth in interconnector capacity. And this is something I'll get back to in 1 second. I talked you through the impact of the ongoing energy transition on max gas running potential, or the top of the switching channel. But here you have the bottom of the channel, or the dynamic mean gas running I explained before. In this chart, in fact, you can also see our forecast dispatch of gas, but I'd rather you focus on the mean levels. You can see here how they become increasingly higher in winters in this time horizon. Now, this is mainly due to German mean gas running. And you can see that if you follow the light green area. As Germany starts to get tighter amid its energy transition from conventional generation to more renewables, its mean gas level gets higher in winters, but is, as I've shown you earlier, squeezed lower in summers. With no nuclear generation and less coal and lignite, Germany becomes increasingly dependent on gas to balance, and so do other markets, France by closing down coal, or Belgium as it exits nuclear. This reliance on gas will only intensify, we believe. Remember, I've talked about how changes in the French nuclear impact gas running across all of Western Europe. And this is because France is so well interconnected. Now, this interdependency between power market fundamentals in one country and gas running potential rising or lowering across the region is only going to strengthen. And not least because of the amount of interconnectors we expect to see coming online within the next 5 years. This chart shows only some of the key examples of interconnector capacity additions we are forecasting. As markets become more interconnected, the energy transition in one country will impact more than domestic fuel running patterns. Interconnectors, combined with a steep increase in wind and solar and the drop in conventional capacity like coal and nuclear, will in time increase the reliance on gas as a balancing fuel across all Western European gas markets. And I would like to end on this note and hand over to you, Wayne, if that's okay. Thank you very much.
Thanks very much for that. That was excellent. And yeah, it brings me nicely onto into my part of the presentation. All right, good morning, everybody. Rohan gave me a nice introduction, so I'm sure you all heard that, so I don't need to repeat that. I'm here now after that just to look at the current market, see where we are in terms of prices, etc. And I'm also going to be looking towards the end just to see how we're looking outlook for this winter. But first, I'll start with the first slide. Now, this is looking how global gas hubs started to converge over the last few months, exacerbated by COVID, obviously. What we saw at the start of this year, we had a bit of uncertainty around the Russian-Ukrainian transit deal. Once that transit deal was signed, we saw prices start to slide. TTF early February, March traded below the summer. Then we had COVID-19, which must have said about 1 million times since that started. And we all know the effects in terms of demand destruction from that spilled into the related fuels market, global market meltdown. And then once that started to happen, the concerns we had at the start of the summer, where we were even talking about, even before the start of the summer, our concerns were where to fit all the gas this summer. It was going to be a very oversupplied market. And then COVID arrives and it sort of exacerbated the problem. We've seen prices then slid to complete lows. But what was interesting was the fact that, as you can see on the red line, which is US Henry Hub, that was always sat traditionally much cheaper than NBP, LNG and TTF. We saw a massive influx of US cargoes, and that gave us the confidence that moving into the summer, it's going to be one of the main supplies. And we looked at it and we said about 4 BCM additional LNG, summer on summer increase, which is now looking really in doubt. And the last couple of weeks, we saw UK gas, and it still is today, I think, the cheapest gas in the world at the moment. Obviously, the price differentials have then seen a lot of cancellations, some from end users due to COVID, but a lot of it's been price-driven as well, and we've seen a lot of US cargoes cancelled into Northwest Europe this summer. Some people have mentioned over 100 cargoes. I mean, the numbers are varying, but the main thing is it won't be as tight as we once thought. And I just wanted to show this is a TTF day ahead, year on year. You can see where we were this time last year. It's almost double the price. We saw a 210 intraday low towards the end of May. Some people then start talking about negative prices, but I think that is something that might not happen, maybe later in the year if possible. And to date, the TTF is down about 58% year on year. Actually, this morning, it's under a bit more pressure again. We've seen a lot of falls in stock markets and rising temperatures, and we've seen TTF day ahead and front month start to trade lower already. Looking at storages, it's a big concern, and it has been. If we look at the similar stages over the last few years, it was usually around 40 to 50% level. Last year, we still had oversupply in the market, obviously, and we're at 62%. Today, we're at about 75%. This went up a percentage point. We're at 75%, and the question is now, when will we be full? Depending on who you listen to and what forecasts, analysts, etc. A lot of people saying by the end of August it could be full. I don't see it being completely full by then, but if the current situation continues, then we will see storages start to rise. However, this slowdown in LNG from the US may make that less difficult. But again, we've still got quite a while till the end of September, and there's still quite a lot of time to fill that gas. But it is a reflection of the oversupply, and it was a big concern, and it still now is a concern, although a bit more tightness in the market has made that, I think, less of a likelihood. Looking at consumption, bear in mind I need to get through these slides a bit quicker. I've got quite a few. Consumption uncharted territory. So we saw the corona impact on consumption, and basically the normal pattern of cold weather, high demand was disrupted. Business activities have changed, loads have changed. Even ourselves at home have changed the way we use energy, and we've seen that looking at this consumption patterns over the last couple of years. Total monthly consumption in Northwest Europe, as you can see, it was already lower than the 4-year average before the onset of COVID. Once COVID come, you can then see the red line and the blue line here, sort of mid-Feb, end of March, really start to slide. We've seen a little bit of improvement over recent weeks as some of the restrictions start to ease, but we're still, overall, I think by the end of the year, I think the consumption is going to be lower year by year. Looking at COVID in terms of impacts, I thought I'll just show this. This is something we developed on our service that looks at the impacts of COVID-19, looking at weather-adjusted demand, taking in synthetics versus actuals. And then as you can see here, I'll just explain this. This is when the lockdown started in Italy. The red line is Italy industrial actual. So you can really see it slide, and we saw the bottom around the middle of April. The blue line here is actually the impact in terms of on consumption, in terms of gigawatt hours per day, and you can see that. But what's most interesting now, as we move towards, or we move out of the lockdown in Italy, you can see that actual consumption is gradually increasing, and the impact of COVID is starting to dim. Now, we've got this chart for several different countries across Northwest Europe, and it looks quite different depending on what country you look at. But Italy is a good barometer, as they were the first to really enact a strict lockdown, and their lockdown was, in fact, stricter than most European countries. So, as you can see now, we're starting to recover. But yeah, COVID has had a massive impact on demand across not just Northwest Europe, but globally. Looking a bit further, Norway, Russia, LNG, for me, it's been the story of the summer thus far. Let's start with Norway. Troll, we saw some of their production get deferred over recent years, but we're still not sure of the cycle. Is it a 1, 2, 3 year cycle? There's a lot of underproduction over a couple of years, and this winter we saw some production has been deferred. And looking over the summer, we've seen Norway have been flexing, and I've got some evidence on the further chart ahead. And I think we looked at the start of the summer and said who would blink first. It to me seems like Norway have blinked slightly ahead of Russia. LNG, its hand's been forced by the situation in the US, but definitely Norway blinked first. This has been a real driver for me this summer as well. Expected maintenances been cancelled, revised, moved along because of COVID, social distancing, getting key personnel to the sites, etc. So the orange line is what we saw in summer 19, which is a typical profile for Norwegian maintenance. Summer 20, this is what we see so far. And we had some more revisions. I think Guflock's got revised today. We've seen a lot of these, not just from Norway, of course, but for the UK, with the IUK has been moved. So we're now going to see a lot more gas because of that. So this is also another bullish factor. But however, if you look further down and look at these revisions, it's quite important because a lot of them are taking place either further in the year or some have been moved into Q1 and further in 2021. But nevertheless, it's important. It's having a real impact on prices at the moment, especially with the moving around of maintenance, which happened quite a lot. There was quite a few revisions to Norwegian maintenance on Friday. So this has given us some expected increases, but also it's given us some increased volatility. As I mentioned, Norway turning down. This chart here, sorry for the colour scheme on this one, 2020, as you can see, is blue line, 2019 red. You can see now the drop-off started just in line with, obviously, COVID, so we would expect lower flows, but we did see it at times with price that we saw some commercial reaction. Also, Equinor spoke earlier in a conference and actually mentioned a floor price for them, and it gave an indication that they're shifting the way they produce moving forward. And looking now, we're seeing actually 2020, you might look at it and why is that a lot higher? That's obviously because there's no maintenance at the moment, or any maintenance is nowhere near the level we saw last year, which is, of course, affecting send out. Looking at LNG, we started our forecast at the start of the summer, and this was when we were all thinking we were going to see a lot more LNG into the US. I think we forecast at the time around 150 MCM per day. Now, we think that is likely going to average this year in June around 120 MCM a day. And we can see here, looking at the different years, the change in LNG send out. We kind of got it right in terms of our forecast, in terms of a slowdown as we head into July and then a pickup. However, I think our slowdown was nowhere near as pronounced. It was more pronounced than we thought it would be. But again, we still see some recovery, but the July recovery, I don't think is going to be as strong as we think it is. This is one of the big reasons, the decline in US feed gas. And this here shows all export terminals, but it looked quite messy if I added all the terminals, and the bulk of the declines were at Sabine Pass. So this is having a real impact. I think we have to look at oil for that. What happened in the oil market, demand destruction, negative prices, etc. This is really seeing the rig count fall. So associated feed gas or associated shale gas production and then feed gas into terminals has really fallen. And it's quite explainable when you look at the numbers. So far in 2020, we've lost 464 oil rigs. We're now down at about, I think it's 205, 206, which are levels we last saw, interestingly, in the aftermath of the global financial crisis. So it's no surprise that drop-off in US oil production has coincided with a big decline in feed gas, and then we've seen the subsequent effect on prices, which has then led to US cancellations. However, when I was looking back at this period, what we saw last time the rig count fell so low, and again, the environment was in a kind of similar place, probably worse now with COVID, but still, the oil rig count was very similar levels in terms of drop-off and level. A year later, we saw it rise by 561 back to over 1,000, or under 1,000. So for me, that can happen again. The oil price now reflects what we might see moving forward. So I think this is going to recover. We're going to see this tick back up. And I think the sooner this starts to recover, I think the sooner we see US LNG exports start to recover, or into Northwest Europe anyway, and become more profitable. And obviously Henry Hub will be affected as well. Qatar is a different story. As you can see, their netbacks have fallen dramatically. And I think looking now, India's the best place for them to send gas, but India is not a place to send LNG at the moment. Firstly, because of what's been going on in terms of coronavirus, country lockdown, and also it's monsoon season starting, so getting the ships in there proves to be quite difficult. UK, interestingly, is close to the bottom, but what we've seen recently, especially since the start of April, is all the LNG deliveries into Southhook, which obviously QP have a share in. They've all been Qatari origin, bar one. Now, this obviously, we all know that there's an agreement with Southhook and Qatar that any sort of, distressed, lost cargoes, or cargoes of last resort will be coming into Southhook, and we've seen that at the moment. So quite interesting to see. And we expect, I think there's a couple more cargoes that have been announced. So we might expect to see stronger Qatari deliveries into the UK. And also when you look at Qatar, I think we saw a few weeks ago they announced they've just secured 60% of global LNG shipbuilding capacity. Now it goes up until 2027, where they're going to build an additional 100 plus LNG ships. They're still going ahead with production and expansion. And actually they came out and said, regardless of the price, we're fine. Other producers may feel the pain, but we're doing fine. So for me, I think Qatari send-out isn't really going to fall that much. And as I mentioned, despite the slowing US exports, there are still plenty of other countries that are there to produce. And you can see Asia as well here. And you look at America, I mean, the red line has, their share has grown, but when you look in the grand scheme of things, they're not as big as some people may think. And I think they will recover, as I've mentioned, moving forward. But we've still got enough alternatives around the world to keep LNG supply coming. And when you look at the forward curve, it's not looking that promising for US exports, really. I mean, if we look at this now, we probably might see some more Henry Hub come into the market a bit later in the year. At the moment, there's definitely no incentives to send any of these cargoes back towards Northwest Europe. Looking at Russia, Russian supply did adjust down a little bit in Q1, not massively, but it adjusted down. A lot of people were saying, will Russia cut this year and going into this summer? They're all interested in market share. There's various different approaches or opinions on Russia. One of the things that did cause a lot of consternation in the market was when the transit concert contract even via Poland expired mid-May. A lot of people were quite concerned that we wouldn't see this usual levels. Of course, we had a small period where we had no flows through there. And then, of course, surprise, Gazprom then started booked some day-ahead capacity for Q3, which gave us some confidence. And then we saw more day-ahead capacity booked. And as of late, amount no flows flowing around normal levels. This little bit here did scare the market and was a bit of a preview what might happen if them flows didn't resume. But yeah, we've had a steady resumption, and since then there's been no real disruption to them flows. ESP sales are growing. We saw a lot of ESP sales in terms of volume February, March and April. Over the last couple of days, we've just seen more announcements that a lot more have been booked as well for June and July. So this again gives us more of an insight into the Russian psyche and the fact we do believe that they do still want to maintain, or still are making efforts to maintain market share. Some of their exports might have been distorted, or export patterns might have been distorted over this summer by off-takers nominating less gas where there's oil indexation present. And I think you may see some of that start to come to the fore in a couple of months, obviously due to the 6-month lag. But Russian overall, I think we're going to see more ESP sales. Their flows are still robust. So I don't think Russia will be turning down anytime soon. Now, I've got a chart further that looks at market share that's within this. So, but for me, and sort of in conclusion on that part there, it's still the same sort of story, really. The sort of acute oversupply that we all expected, I don't think is there at present. There is still an element of it, but I think just the fact that this LNG slowdown is happening and the reaction we've seen on Q3 prices shows you the market isn't as comfortable as it once was. And here's the chart I was talking about. So LNG was crashing the party in Europe. And as you can see here, really, really rising. But I think as we move forward, that is then going to start to tail back down. But it's done very well over the past few years, and as you can see now, it's third in line. But Russia still is up there, as is Norway, but we still do believe the Russian is going to outturn higher moving forward. Just a quick look now. Here at Refinitiv, we don't produce any real forecasts out into the winter yet. Our winter outlook won't be out until September. So I just put together a couple of charts, and I suppose I'll put them together with some related fuels just to have a look at that as well. So looking at the winter TTF, you can see it hit a low, but as of late, we've really started to pick up. I think today it's off a little bit in line with the rest of the curve, but it's still starting to pick up. And in terms of correlations, this is looking at the correlation with coal. Now, I know the coal switching isn't really going to happen probably until the start of next year if you look at the forward curve, but there still is an element of some form of correlation. I mean, at the moment, we're seeing coal take a leg up, mainly thanks to the collapse of the bridge in Russia. Also, as well, when you look forward into the summer, I think, or towards the end of the summer, there's a lot of talk of, and I'm not really sure about this, but people have mentioned it, that if a lot of economies then go into rebuild mode once the COVID-19 pandemic is over, will they be looking to use dirty coal more to help rebuild their economies and prioritize that over emissions? I'm not too sure about that. However, coal is also going to take some boost from nuclear concerns. Now, nuclear concerns are not only in France, in the EDF, but Belgium and UK as well. So I still think the coal market outlook is rather bleak moving forward, but I think short term, again, and we've seen it before when nuclear has been out or we've had no renewables running in the winter and it's a cold day, that we've seen coal still being used. And I know Rohan mentioned earlier that we haven't used coal in the UK now for a record number of days, but I think the price action shows you as well that market believes coal still can have some impact moving forward, but longer term, I still see the future's looking quite bleak. In terms of carbon markets, the correlation was really strong until the past few days, the past few weeks actually. But the carbon market now is really, really surprised and headed way back up. I think ahead of its expectations personally, really back to near the levels just before the COVID-19 disruption started. Looking forward into the next few months for carbon, I think it's going to follow the general trend of what we're seeing in the global markets. I think today it's off again, but so is oil and so are equities. So it's kind of following that as well. And also, if you look at the emissions, I don't think emissions come anywhere near as strong as they were. We might see a bounce once these economies start recovering, but I still do believe there's more downside to come in that market. And looking at Brent, and Brent's probably the most interesting thing now because we all knew there was always some form of correlation between Brent and specifically seasonal contracts, and obviously with the lags, it's a good time to sort of start looking at it now. And what I think is going to be interesting now is the relationship might change because once the oil price starts going back up, we're going to see more associated gas, which should feed into more feed gas into LNG terminals, which may spark what we were talking about earlier in terms of more cargoes arriving into Northwest Europe later on in the year, possibly August, September. As I mentioned as well, with this rising rig count or recovering rig count, I think it's going to start to happen over the coming weeks. We're going to see that change. And if economies do really start to continue to open up and demand does start to recover, we could see oil prices head back towards 50. Then I think that will encourage more drillers back online, which may lead to more gas. So the relationship between these two might change. I think it's quite interesting. In terms of my conclusions, I'm just going to go over some of the stuff that I said. But first, I'll just finish with the winter first. I think with the winter, it's going to be now, the concerns are going to be around the usual ones. Like when I was trading a couple of years ago, French nuclear was a constant winter issue. So we're going to have that. Weather's always going to play an impact. Is there going to be a second wave of COVID? That for me is the big uncertainty. And for me, it's far too early for anyone to make these sort of predictions based on that, because we just don't know. And if we have another outbreak in the winter in conjunction with what normally happens, the winter flus, etc., then we could really be in trouble and see some of these lockdowns reintroduced. So I think this winter, I think at the moment I'd be slightly bearish on it in terms of supply fundamentals, and maybe demand won't be as strong, but there's still a lot of variables that can change before we even get close to the winter and thinking about prices. So for me, looking at my conclusions, will US LNG recover? Alternative sources, I've mentioned that, Qatar quite a lot. Rig count, 206. And again, the recovery was swift in the aftermath of the GFC. Feed gas recovery, I still think that will happen once the oil price starts to increase. Another thing I didn't really put the charts on because I've sort of run out of time, but global PMI is something I look at quite a lot. If you look at the global one, cross-sector output continues to fall, albeit at a reduced level, and tourism remains the biggest laggard, and tourism-related demand is quite large across the world, and I think that sector's really going to struggle. Even if we do see some of these air bridges or some countries accepting tourists from others, I personally believe that people themselves won't want to travel as much. If you look at the Eurozone, composite PMI just released a few days ago, increased in May, but 31.9, still a dismal level and still in contraction. We're seeing broad-based improvements in Italy, Germany and France, but if you look at optimism, predicted output, orders, etc., we're still in a lot of trouble, I believe, and I think some of these financial markets have got ahead of themselves in that respect. And as I put on here, risk on mode in financial markets, as countries slowly ramp up economic activity, can be bullish. Related fuels will benefit, and for me, it's an excellent risk for European gas markets. I mentioned nuclear output. You can see here, UK nuclear output currently at 5.5 against an installed capacity of 9 gig. So winter concerns are indeed rising. National Grid have tried to assuage them concerns by saying they'll turn, I think, Sizewell back on, but still no news on that. Steep drop in French nuclear availability, as we've seen in the earlier presentation. Q3 looking big at around 29 gig, and Q4 we're seeing falls as well. I mentioned Norway, already been optimizing. Further cuts may be required. Still got uncertainty around Troll. Maintenance reschedule, again, it's adding more supply. Further cancellation revisions are to be expected, and I've been having this myself when I've been writing some of our morning reports, that revisions are getting made constantly, so you really have to keep an eye on these websites to find out what revisions are being cancelled, sorry, what maintenances are being cancelled, revised, because it is having an impact. Russia, I've mentioned it, continuing to push strong volumes under its ESP, looking to maintain its market share. I mentioned Ukrainian storage. I didn't put a chart on it. People have been talking about it. Currently at 60% fullness. They're offering a customs-free program with, I think, no tax, etc., or tax cuts. And they said that what they said earlier was they reckon there's around 12 BCM available for European traders. Capacity fees have also been discounted. Now, there's mixed stories on this. Some people are saying it's going to be heavily used. I think it will be utilised, but not at the really high level. I think the capacity might be a concern. But it's still an option, and I don't think European storages, as of yet, are at that danger level where you'd be looking to divert it into Ukrainian storages. Didn't mention renewables once, but I've been talking about it quite a bit internally recently, especially solar. UK solar had its best month in history in May. And again, we see solar and biomass in the UK. And obviously, I've talked about the rest of Europe's rising as well, but in the UK especially, really rising. I think at one point last week, I think 49% of our energy was being covered by renewables. So it's really decreasing offtake from the power sector. And I think it's something to keep an eye on moving forward. I know it's intermittent. However, in certain days, we're seeing it provide a lot and really seeing gas for power generation at low levels. I think now at 10:55, I best stop talking. Thanks for your time, everyone. And anyone got any questions, feel free to email this inbox or you can contact me directly. Thank you very much.
Thanks a lot, Brian. Thanks a lot, Wayne. Sorry. I always call you.
Thank you.
Brian.
You always call me Brian, but yeah, thank you.
I know.
You're not alone. You're not alone.
Yeah, absolutely. Yeah. Brian Wayne, I think that's the reason. Bruce Wayne, that's the reason behind that. So I appreciate it. And Maria and Wayne, really, really good insights. I know there are plenty of questions coming in. So I think, as I mentioned at the beginning, we will try and answer for you as much as we can within the hour slot we have, but we will definitely try and reach out to you individually for your questions wherever we can. And as I think, as Wayne mentioned, obviously you can reach out to us directly. There will be a little pop-up survey at the end as well with your feedback, and I think any questions you have, you can put them in there. But let's try and tackle one or two quick questions. And Maria, I think there's a lot of discussion about the nuclear capacity and the nuclear production as well. And I think EDF stated some of their targets and kind of expectations for the future as well. So I'll just read out the question for you, Anna Maria, and you can probably comment on this one. Why French nuclear capacity only will put down in 2021 and 22, and then it will increase in 2023? Anna Maria?
Thank you. Hello, can you hear me? Hello?
Yes, we can hear you. Yep.
Hi, Rohan. Yeah, that's a good question. Thank you, whoever put that question. It's a good detail to pick up on. So the simple reason we believe that EDF's Fessenheim 1 and 2 reactors, so of a combined 1.8 gigawatt capacity, will close in 2020. And then there is a company target for 2023 that EDF still maintains for the startup of Flamanville 3, and that adds 1.6 gigawatt capacity only in 2023. So this explains the question. But perhaps something that I would point out, if we are on this, I would say that if you look at winter 19. And look at how low the French nuclear output was. Now that was due to both lower availability because of forced outages, but also because of price responsive unavailability. Right. So perhaps more importantly within this time horizon, I would say, is the potential downside risk to our view of nuclear running. Because demand, we expect to return to normal levels in the following years. And we expect France, as I mentioned, to get longer as a net position because of the growth in renewables over this forecast horizon. Thank you, Rohan.
Brilliant. Really interesting. That's cool. I think when we can take a quick question for you as well, and this was in relation to the LNG. Will there be a U.S. LNG export recovery into Europe, and when?
I think, as I mentioned, I think there will be. I think if you look at the curve, you look like we could see some later on towards the sort of September, October, we may see some recovery. But again, as I mentioned, there's so many variables and so many things that can happen in between now and then that are still, it's uncertain. But I think if things develop how I think they'll develop, and if basically the global markets continue to rise and we see the world beginning to go back to work and social life returns to normal, etc., then I think, yes, because oil will rise, everything else will rise, rigs will come back, feed gas will start to rise again, and then we'll see them deliveries return. But again, I think there's far too many uncertainties over the next month or two to think about. I think it will recover, yes.
Understood. So I think I really appreciate, guys. There are a number of questions, but I reckon we only have probably 30 more seconds to go. So I probably won't get another one to answer. But as I mentioned, I think all the questions we have, we will ensure that we reach out to you individually, collate all the answers from Wayne and Anna Maria, and then have it all collectively shared across with the group. The recording of this webinar, as again, you will receive the webinar recording in a post-webinar communication from our team. What we would really appreciate is that there will be, again, a pop-up survey at the end. Please do identify any feedback, questions, any more that you have. And obviously, if you would like to speak to any one of our experts about the solutions over Icon, the data insights that we have available in partnership with S&P Global Platts, as well as all the insights from our natural gas and LNG teams that are available via Icon, please do identify if you would like to have a discussion around that so that our specialists can reach out to you. With that, I really appreciate everyone dialing in. Hope you have a fabulous day ahead of you. Appreciate Anna Maria and Bain once again. Fabulous insights, and highly appreciate the overall coverage that you guys have provided us on this webinar today. I hope you will dial in any future webinar that we are going to have in partnership, and hopefully you'll hear from us soon again. Many thanks and goodbye.